Okay, hello everybody, and welcome to Investing with IBD, sponsored by MarketSmith. Today is April 1st, 2020. I'm your host, Arusha Pierce, and we have two special guests today on the podcast. We have Scott O'Neill, CEO of Data Analysis Incorporated, and Steve Birch, CEO of William O'Neill and Company. Scott and Steve, thanks for being here.
Thank you.
In addition to being executives at the O'Neill Companies, Scott and Steve are also longtime portfolio managers at the firm, and both of them have survived a number of bear markets. They were also the creators of the MarketSmith product back in 2010. So we're going to talk about their experiences in the market. We'll talk about MarketSmith, and also we'll go into a number of other topics, including how to prepare for the next uptrend. But first, let's talk about the current market. The market's in a correction, and it's volatile. We nearly had a follow-through day on Monday, March 30th, but the volume was a little bit lower. The coronavirus headlines obviously continue to dominate. Guys, what are your thoughts on this market right now?
Steve, go ahead.
Okay.
Sorry.
Hey, everyone. Hey, Arusha, thanks for having Scott and I on. This has been an unprecedented, as everyone said, market environment. We've had just a tremendous evaporation of wealth in the country with this market loss of almost 30% from that February 19th high to the bottom. I'll just comment a little bit about market timing, and for people that are using MarketSmith or have read Bill's book, they should be pretty comfortable with this. And if they haven't, it would be, and I'm sure, Rishi, you've talked about this on previous podcasts, but it's always good to go back to the basics of these concepts of trying to identify significant turning points in the market. And so, the follow-through day concept is one that Bill had written about. Actually, you know what I'll do? Let me read you guys this great quote from the second edition, if I can find it here on my computer. And this comes out of the second edition on page 47 of How to Make Money in Stocks. Bill wrote, "Recognizing when the market has hit a top or bottomed out is 50% of the whole complicated ball game. It is also the key investing skill that all too many professional and amateur investors seem to lack." And that is a very powerful statement. So many people do not pay attention to the M factor, and they end up thinking there's a bull market everywhere. And this is a situation that we're witnessing in history where, and I'm sure people have opened up their statements, they're getting their March statements and thinking, oh my God, what just happened, on their 401ks and others. And so there's this tendency to, you're kind of in shock, you can't freeze up, and you've got to respond. And if you're going to trade off of your emotions, you could get yourself into even worse shape. And so the spirit behind these rules around looking for distribution during market tops and looking for what we call a follow through at a market bottom really is to help us eliminate the emotion from our decisions. And Bill did a great job at really documenting the mistakes that he made, and then how he kind of refined this market timing strategy and how critical it is. So, Scott, what do you remember about, Scott and I have been managing capital for the family for decades. There are many times when Bill would pull us aside, and this, even to seasoned people that were managing money, oftentimes we would, tweak the rule a little too much, or we wouldn't interpretate it in the most orthodox fashion. And I remember you and I were talking about 2002, what had happened during that bottom, and how critical it was that we all get regrounded in follow-through days. You remember that, Scott, when all the PMs got pulled in by Bill to kind of review this, what had happened? That was a great teaching moment, if you will.
Yeah, it was. My dad was frustrated because some of us, we were all battered and bruised, and some of us, including myself, we did not buy initially on that October 2002 follow through, and he was not happy about that. And so, yes, we all got called in and we walked through it and again. And it is important to stay very, not just patient, but very balanced. And when you get a follow through, most of the time you don't feel like buying. He says it right in the book. And likewise, right before this break where we gapped down really hard, we had 2 days down and then we gapped hard and on the NASDAQ and got to the 50-day and then we just kept plunging. You know, there's the old saying, there's the quick and the dead. And we didn't know that this was going to materialize as it has. And we may or may not be through this yet. But what we did know was that we were going down, and it was simply by monitoring the distribution day count. And that's something that the IBD markets team is expert at this point. I mean, you're talking about 3 decades of doing this analysis. And in that time period, you had 87 break, you had the 2000 break, you had the '08 break, and now you have this. But to come full circle, we don't know how bad a downtrend is going to materialize either. But what we do know through this process is that we are going down, and you have to start backing away and get out. And if it really starts, because it accelerates, right? Steve, how many times have we seen where it just feeds on itself and it starts to accelerate?
Yeah, no, I think I'm going to quote you guys another great section out of the second edition. Bill wrote this. He said, "The market has a simple way of whittling all excessive pride and overblown egos down to size. After all, the whole idea is to be completely objective and recognize what the marketplace is telling you, rather than try to prove that the thing you said or did yesterday or 6 weeks ago was right. The fastest way to take a bath in the stock market or go broke is to try to prove that you are right and the market is wrong. In the final analysis, there is only one thing you can really do when a new bear market begins. That is to have the sense to sell and get out or go short. When you get out, you should stay out until the bear market is over. This usually means 9 months. And in the prolonged problem-ridden 1969 to 70 and 73 to 74 periods, it meant 2 years." Now, what Bill is talking about is, okay, you want to stay out until the market bottoms. Well, how do we determine a market bottom? That's really what the follow-through concept is trying to help us address, right? So that it is so tempting for people to read the news and project their personal opinion on what they think is going to happen. It's an exciting intellectual exercise. I think it's going to be a V bottom, or no, I think it's going to be a depression-like correction. And no one knows. No one has a crystal ball. We do not have a crystal ball. We do not pretend that we have a crystal ball. So
we don't predict.
We don't predict. Scott and I don't watch the television. We don't have that streaming because it's exciting. We really go off of this historical model that Bill so well wrote about and documented. And I guess about 10 or 12 years ago, we at William O'Neill, we did a study, and we updated the study, went all the way out to 1900, and we created this poster that really helped document the statistics around follow-through days over the last 23 market cycles, what you typically see. And we were looking at, how many days off the bottom would you have to wait? We don't look for follow-throughs on the first, second, and third day. That's typically a dead cat bounce and can lead to a lot of head fakes. So it's on day 4 through 10 or longer. There's a typical, range of strength in terms of price appreciation, and there's typical volume that indicates the tide is turning and the buyers are now starting to come back in force, right? And that was all consistent with what Bill, had written about. And so what's really critical, and as Arusha, noted earlier, is I've seen too many examples of people who try to anticipate. I think it's going to follow through, and they start putting money back at risk, and they put risk on. and then you get chopped up and it's death by 1,000 cuts. This is not one of those, oh, it's correcting back to a 50-day or 200-day and it's going to bounce back because that's what it always did before. This is a historic sell-off, and no one can really look at any example in the past to accurately think about how this is going to end up playing out, right? We don't know with the government programs. We don't know how long we're going to be in lockdown. We don't know, there are so many crazy numbers flying around on how many people will be unemployed. And it's not just isolated to one country. It's worldwide, right? So there's so many things here that should alarm you just from a pure risk perspective, that it's so different that I need to be more cautious in my impatience and my enthusiasm if I'm like, especially if you're trying to make back money that you just lost, right? So a lot of these things that I'm discussing are common emotional, traps that we all fall into. And, the best thing to do when you're not making progress and you find that you're being emotionally charged and driven in your investing is to follow some rules. And I had that repeated to me. I've been at William O'Neill for 25 years. I worked with Bill as a portfolio manager for at least 15 of those years, and run William O'Neill and Company. And that was a mantra, was follow your rules. They're there for a reason. So I'm going to get back to your question, Arisha. I'm sorry that I'm digressing, but we did have almost a follow through. It's not there yet. We definitely know where the low is. One thing that your audience should be thinking about is if you do get a follow through. And this is something that Scott and I learned in that 2002 conversation, is if you get a follow through and you can read the big picture and you can consult investors.com and MarketSmith, you'll see, okay, we've got it in one of the indexes, the NASDAQ, the S&P, or the Dow. You have to buy something. You have to buy something. There are times when you're so scared that you're like, well, I'm going to wait. And in 2002, mind you, we had many false signals, many false positives. After the market went through its 99 bubble 2000 peak, there were many follow-throughs that failed. And we just sort of gave up and said, there are so many, it's not going to work. Scott and I would do these little positions, they had no significant impact on our portfolio. They were simply probes, little probes that we would put out. And we would do that pretty regularly during the 2001 bear, right? But the market wore us out. And by 2002, we were so negative and so cynical that we're like, yeah, it's going to fail again. And we didn't do anything, right? And so there was a follow through back there. And I think there was one in late 2002 and then another one in early 2003. And the way I recall the story was, nobody was really that active in the market. No one was. We weren't investing. No one was doing any probes. And one of the follow-throughs started to work. And some of the high relative strength stocks started to outperform. And Bill looked at the list of all the portfolio managers and what were they buying. And there was only one portfolio manager on the list that had bought anything, and it was Bill O'Neill. And he pulled us into a room, and we had.
That's true. It's true.
He goes, we're having and we didn't often have a lot of meetings. We were very independently managed. Bill was great about that. He was very much gave every person a lot of autonomy. And I think we had probably a dozen portfolio managers. And we had this meeting, and I'm, oh God, what's this about? Because we don't normally have big meetings. And we walked into this conference room, and on the wall, Bill had taped all these copies of IBD, the big picture page, the page that had the general market indicator page, going back, I don't know, Scott, it was like probably 10 years or 15 years.
Wow.
And on every one of those, he had marked up all the follow-throughs by hand. And he marked the distribution. And he sort of asked us, do you guys know what a follow-through is? We're like, oh, yeah. And he goes, well, how come no one bought anything? And all the responses were, well, we don't think it's real and it's going to fail again. And they were all these very emotional, sort of, and he just looked at us and said, you absolutely have to buy something because it might be the market bottom. Not every follow through signifies a market bottom. There are many false positives, but every market bottom that we've studied over the last 23 market cycles has had a follow through day, right?
Yep.
So you say, okay, this is a characteristic that, it's like profiling, right? I mean, not everything you profile is going to be what you think it is, but you're going to end up with one where you're right. I'm glad I profiled it. That was a market bottom. And guess what? I got in at a really good price with some of these leading names that are showing good relative strength rank. And at that time, Bill had bought eBay, and that was his a very, very successful position, very, very early. And it was a relatively unknown name, and no one else had bought anything. And here's Bill O'Neill with the only real decent growth merchandise, and we're just like, we're so late, and we have to now wait for a proper setup and a proper base to try to get established. And so he was mentally just light years ahead of us, and knowing that he was just following his rules. And he was very good at just compartmentalizing and not worrying about what had happened the prior year or two, and not trying to, chase performance or make back losses. The market doesn't care what you make or lose. It's just going to do what it's going to do, So I love telling that story.
Let me add something here, Steve, to that exact point that's very interesting. There's two big benefits to buying on the follow-through day. And obviously, you get a toehold into a couple of key positions that, if it works, are going to play out very significant for you. And we all know the big money is made being in at the very beginning, at the turn. There's another aspect to this that we cannot undervalue. Your mental, the thought process, you are shifting from completely out of the market and negative to gradually getting more positive on the environment in your mind. And you're making that shift along with the market. Now, occasionally it does fail, and usually they fail fairly quickly and they'll fizzle out and you back away. And we're not plungers. We incrementally move in. So, hey, no harm, no foul. But that mental shift is a big deal. Steve, you want to comment on that?
Yeah, I think it's very, very easy to get both on the upside when you're making a lot of money and the market seems to be, just never going down and giving you wonderful corrections. But you've got to be nimble, and you've got to be somewhat of a contrarian in your own mind to say that there's going to be a time when this 11-year bull market's going to be over, and I'm going to see that in the price action. And likewise, for all the negativity that is in front of us regarding this virus and the possible impact on the economy, you have to be a bit of a contrarian and say, but it will pass. There's going to be a moment where the market recognizes that too, and we're going to see that in technical action, right? That's the wonderful thing about using technicals to help you gauge the overall direction of the market, right? You're not using your opinion, you're not using some economic report or fundamental report. You're really measuring the tape through that index, and that represents sort of that composite man's view, and you want to trade in harmony with that. So I think rules help me to really just filter out the emotion. It's so easy when you talk to anyone to get emotional and start projecting what you want the market to do, and that can get you into trouble. So we're real advocates of this. We believe in this. I'll share this with your listeners. So many people don't think you can time the market, but we've used these general principles of distribution and follow-through days, and we apply them at William O'Neill across the globe, right? So we look at, I think we look at about 32 global markets using the same concept, and we classify them. Are you in an uptrend? Are you in an uptrend under pressure? Are you in a downtrend? Or are you trying to make a rally attempt off kind of a bear environment? And what's really interesting, this I'd like to share this, is the Chinese market had a follow through on March 25th, and then the Hong Kong market on the same day. Then Japan followed 2 days later. The Tokyo Stock Exchange had to follow through. And then about 3 days, 4 days after that, the Indian market over there in Asia. And then I talked to some of our analysts yesterday, and I believe that even some of the markets in Europe had follow-through days. The only market that has not had one is the US. Now, it's sort of in sync with what's happening with the virus, right? It first started in China, and then it moved to Europe, and then lastly, it lands in the United States. Now, that sounds bullish, right? I mean, okay, some of the markets have followed through, but I looked at the charts earlier to this broadcast, and the Shanghai index only needs to decline by 3.2%, and it will undercut its prior low, and the follow through will fail. And so one of the things that we're watching is, and this is a nice little statistic to remember, is if you get the follow through, Steve and Scott said you have to buy something. Now that's right, and I'm not advocating or talking about the whole portfolio or going on margin, but you have got to get over that factor of like, I'm just going to wait and see. You've got to put something in. It should be a very small part of the portfolio. Once you buy it, what's your expectation? We're in a brand new bull market. That was a come on V bottom. We went down really fast like an elevator, and we're going to go up really fast like an elevator. Well, we know from studying the prior 23 market cycles that if it fails, if this follow through signal fails, it's going to do it within 2 weeks. When they fail, they tend to fail within 2 weeks. That's not a very long time. So then if you've got risk on and you've established a position, you've got to be asking yourself, okay, I'm going to look at the prior low, and we're 3% away from that, or in the case of Hong Kong and Japan, we're about 8 or 9% away. And you might think, okay, there's enough of a cushion there. I don't think we're going to undercut that low. Well, you might be right, you might be wrong, but if the market can hold the low for longer than 2 weeks, the probability that that's the real bottom dramatically increases, right? So we're always very cautious. We always buy something, but we always know that there's this 2-week test window. It might not work. And so you're extra careful with how much you buy. I know too many people that plunge because, well, it's a follow through, and they're not really thinking about, the risks of being wrong. And then if you get into a 2000 kind of market where we had multiple, 10, 11, 12 signal failures in that terrible, terrible correction, you start saying, I don't believe in this, and you won't use it. And then the next bull market will emerge and you won't be there. And so we've been using the process, and Abrish, I'll also mention, we believe in these concepts of follow through and distribution. That about 3 years ago, our family office developed a completely algorithmic, systematic strategy with no human intervention, all rules-based, that we call Chameleon. And this strategy, the name is that we will go long the market when we get that follow-through day, and we will reduce some of our exposure when we start to get under pressure, and then when we go into a downtrend and see all this distribution coming into the market, we flip and we go short the market. We are running that strategy today as we speak. The family office has a team of quants that run these systematic strategies. And we experimented with this because Bill was he's such an early quant. He really was one of the earliest adopters of the computer to rate and rank stocks. In his mind, he had a near photographic memory for chart patterns and charts, but he never felt that it was something that other people could master. He said it was all about rules. And he tried to eloquently write down and document how this master applies, all his observations in the books that he's written. So we really took the spirit of the rules, and we wrote this strategy called Chameleon. And I think the strategy now, I haven't seen it, Scott, I don't know if you checked it today, but I think the Chameleon strategy is up 14% year to date. And it's done phenomenally well in difficult periods, right? Because of its ability to to sense when there's these major turning points. So
I pulled it up right now, Steve. It's at 16%.
Yeah, so it's up 16%, and it's just done a phenomenal job. Did really well in late 18 when a lot of our listeners and a lot of people that were growth oriented discretionary managers struggled. We have a group of discretionary managers, and I know Scott and I know how they struggled during that period. But Chameleon flipped and went short, and completely unbiased, no opinions, just reads the signals and says, okay, you have to be short this market. So this is something
and Steve, Chameleon is just going with the overall market, right?
That's all it does. Yeah,
long the market, short the market, not necessarily going with the individual stocks.
It doesn't do individual stocks. It just goes long and short in ETF, and it's a very pure application of this market timing approach. And it's not meant to be a relative performance strategy, or it's meant to just offer you and offers us some access to market timing, right? We know that is, there are times when our bias and our viewpoint is very optimistic, and by nature, as a growth investor, I would say most of your listeners are probably pretty optimistic people,
right?
Because they're looking at the glass is half full. They're really thinking about how these businesses that they're investing in are going to do well, and they're not inherently short biased or cynical, right? So we're predisposed the same way in the family office, and then sometimes that causes us not to respect the distribution and just hope that it's not going to be severe. But the computer doesn't have any emotion; it just follows the rules.
Yep.
So it's a really interesting application of what Bill taught us.
Perfect. So Steve, let's take a quick break here. The U.S. market is still in a correction. We're in a bear market, so obviously the key is to survive and be patient. But when we return, we are going to talk about the O'Neill organization. It's a global organization, and so we'll talk with Steve, and we'll hear what he's hearing from our fellow employees in China and India, and how things are going with them with the coronavirus. We'll be back. I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks. Just on the U.S., I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020. Scott O'Neill and Steve Birch are our guests with Investing with IBD, sponsored by MarketSmith. Okay, so let's before we get into the O'Neill companies, let's first spend a little bit more time on the follow 3-day concept, because we want to make sure everyone's clear on this. And so we nearly had a couple of follow through days in the last week and a half. Now, the first one was on March 26th. We had the price action, but the volume was a little bit lower. But there was one key why March 26th was going to count as a follow-through day. It was because on March 23rd, we were looking at that, even though it was a down day, we were looking at it as a pink rally day and counting that as the first day of an attempted rally. So that was the first one. And then on Monday, that was kind of the more traditional count, where we had the price, but we didn't get the volume. So neither of them qualified. Guys, let's talk about this follow through day concept and really kind of the spirit behind it, especially after such a severe sell-off.
Sure, I'll take that. Well, that day you mentioned, March 23rd, you did log your low at 6,631 on the NASDAQ. This pink rally day concept was really marginal. You really want that the bottom is established and then you close above the previous day. And again, this is like earlier what Steve said, Bill being an early quant, he went back and just analyzed visually the charts of every bottom. The follow-through day is designed, to get you in at the beginning of a new trend up. And as Steve said, there are some false positives, and there's a method in deploying capital, slowly, incrementally moving back in, no plunging. The couple of items I want to point out. First, there's a reason why we're looking on the fourth day and beyond, and it really has to do with power and also keeping you out of a typically in a hard break, you will get a short squeeze or two. On the way down, you'll have that one fabulous day up. And if anyone is looking at their MarketSmith chart, you had that day is March 13 as an example. And you can bet, and then there's another one actually right near the bottom, and that one is March 17. You had short squeezes in there. So this is really not true buying for a long position. And so that's the wrong environment we want to enter. And so being on the fourth day and beyond, that keeps you out of that kind of, and the news media always gets so excited on the really big day. Wow, we were up so huge. In fact, this one day, which was March 13, okay, we're up 9%.
Yeah, that was a monster day, and everyone was very, very excited about that day on the media,
and
right?
then what happened? And Arusha,
Exactly.
What happened the very next day?
They just gapped it down, everybody.
Massive gap down, and look how you'd have gotten caught, right? We were down 12.3% the next day. So Steve's talking about rules. These are sound rules to follow. It forces you to keep, if you follow them, keep your emotion out and just be very objective and interpret what the action is telling you, what the market's telling you.
Yeah, I think.
One last thing.
Go ahead, Scott.
Hey, Arusha, I'm sorry, buddy. One last thing. The follow-through day should give you the feel of real brute strength, right? Now, yes. The two that we were kind of close, they relative to what's been going on, they just didn't feel really powerful. And I got a great story. Steve, you and I have talked numerous times over the decades about when we get hit the next couple of days, or let's say we have a really bad day or two, the next couple of days, the market has to right itself. And talk about the percent that we've discussed. You got to make back kind of as a rule of thumb for the market to kind of correct its bad behavior the previous few days. You remember those discussions we've had?
Yeah. Usually you want to make back at least half of what you gave up the prior day or in the prior downtrend. So when you're measuring corrections or, and if you guys remember these concepts of a base, right? One of the elements of looking at a trading range that a stock goes in, Bill would always say, make sure the stock is in the upper half of the base, right? So this notion of 50%, you want to see, let's say that we suffer through a 10% decline during 1 week of really, really ugly trading. And you get one up day and you're up 2%. You get another and you're up another 2%. You're up 4%. And then it sort of stalls. You haven't really made back half of those prior losses. You lost 10%. Now you only made back 4%. Scott and I would often talk about, that's not a sign of resiliency. That's not a sign of real buying demand. We really want to come in to see that there's been a reversal. There's tons of volume. People are paying more. We're not trying to find the low tick on the chart. We know we're not going to get that using a follow through day, but we're going to give that up for more assurances that we've actually turned the corner and that is the true bottom. The other thing to remember, and I tell this to our portfolio managers all the time, we have some younger ones that are not as experienced and seasoned, and they're often a little impatient. The biggest thing that affects a newer investor is this idea that, well, I want to make money now, and so I'm just going to think I'm going to try to extract that out of the market. And you have to remind people that in a real bull market, a legitimate bull market it's going to have the wind at its back, where you're going to have many, many opportunities. If you are a little bit late and you don't buy exactly on the follow through day, or you come in, you're being cautious and you buy it on the 6th or 7th day or whatever, you're still going to have plenty of time to make good money. So I caution people that I know people that buy on the 1st, 2nd, and 3rd day, they're not using the follow through concept, and they're carrying a lot of risk, and they're all doing it because they're so anxious to get back in. So the rules force you to be patient, be disciplined, read that tape, watch the action, and you're always grading the market. At the end of the day, you're trying to ask, where do I see most of the action? Is it on the buy side, or do we have a lot more buyers than sellers? And are we seeing that in the volume and in the price? Or is it on the sell side? And then once
let me add something. That's a great subject to actually dig a little deeper on. When Steve's right, a real bull market starts to get going. Now, the very strongest, highest RS stocks that will emerge on that follow through day, sometimes we've seen where they'll emerge a day or two prior. Okay, nothing is perfect, nothing's exact, but if you can get it pretty close, you're going to do really well, right? And then the next few days, a couple more stocks break out. And then the next few days, a few more. Then the next week, a few more. And so that's the process. Now, it's incrementally more profitable if you catch it at the very beginning. But Steve's right. You got to be patient, because they will emerge. And then the next group starts to emerge. Remember, stocks move in groups, right? And then a few members of another group start to emerge. And in a real bull market, a true bull market, it's roughly about 40 groups that participate, give or take, right? And so, yeah, we want to be patient and really like a robot, just systematically, as our stocks are working, we say, okay, you've earned the right stock market to get some more of my money. I'm going to place another trade and then another trade, because they're working. The people that get tripped up are the impatient ones, or the ones trying to scalp a point or two, or think they're smarter than everyone else. They're always the ones that get run over.
And Scott, let me add for the listeners out there that might be, as we preach patience, some would say, well, what am I supposed to do if I'm being super disciplined and I'm not active? And, it's like watching paint dry. Well, Scott and I sat in cash, for many, many months. I think I was in cash for almost 18 months after the market peaked in 2000. And I barely traded. So what did I do? Well, you go back, number one, you go back and do your trade analysis, what we call post analysis. Everyone should do that when you've got downtime. If you're screening your charts every single day, that's great discipline. But you're probably getting jumpy and probably getting impatient. And then I also, just personally, I read a lot about the market. So I have a big collection of books that go back to the 1800s, and I study really just the psychology and how people were reporting at the time and what was going on, and try to put myself back in history to think about parallels that might be occurring now. It's sort of my fundamental way of staying in touch with history and seeing if I can apply that to today. So I just enjoy that. But there's so much you can do if you're not And if you're also working and you're busy, you don't have to feel so, I got to be glued to this every single night. If you're in a bear market, you just want to be in cash. That's one of our primary tenets, is you want to trade in harmony with the direction of the market. So if the follow through fails, then you just sit on the sidelines and be patient, and not, you don't have to be obsessed about, making money. And I think it's going to do this and do that. It's really about discipline. The other interesting thing, Scott, isn't it interesting how you and I have talked about how, when you're in a really strong bull market, we're managing a lot of businesses. We're managing portfolios. We've got a lot of things going on. So Scott and I can't sit in front of a monitor all day, but we do trade with margin, right? And so there is risk that our firm carries, and yet we're able to sleep at night. And we're able to sleep at night because we're trading in harmony with that market. We're paying attention to the signals. We're not getting the distribution. Our teams have been buying at proper buy points. And we just know intuitively that, hey, this is not as stressful. But when the tenor changes, and when your team starts to, the batting average goes down and they're booking more losses than normal, and breakouts start to reverse and they start to fail, we start taking risk off and we start commenting to each other, hey, it's getting more difficult. And something's changing in the ether, right? And, when you're in a good bull market, for those people that have read Bill's book and that really apply the principles, and you're waiting for good setups to get in and you're buying great quality growth names, you'll start to see like, hey, this is what I remember. It's actually, I'm making money again. My ideas are working, right? If you start probing, like Scott and I did, and we would do small probes, because you'll get your hand slapped within 2 weeks, or you'll think you found the new leadership, but you're in a choppy rotational market and you're like, oh my God, I lost money again and again. And so you really have to kind of get in touch with sort of your psychology of, I know how I think and feel, and I know how difficult it is when it's a good, strong bull market. I'm in sync with that. And I know when I struggle and I'm throwing caution to the wind, I'm not using my rules and I'm losing money. Well, that's when you have to take risk off, and that's when you have to reduce your exposure, and you have to either just stop completely and give yourself a break, or really, really dial down your exposure. I mean, we used to do 100, Scott and I would joke about it, going, yeah, I'm going to buy 100 shares. And we knew it didn't make any difference, but
let's see if it can survive.
But, we picked that up from Bill, because I know I saw him do that too. And I would always wonder, why is he buying 100 shares? It's like, it doesn't make any difference to his portfolio. But it's amazing, even with a 100 share position, you look at your monitor differently, and you want to be a winner. You're like, I hope I'm right. I hope I'm calling it. And I'm not really obsessed with how much money I'm making with the position. I'm just trying to prove that I'm getting back in sync, that I'm reading the charts properly, and I'm interpreting the tape properly, and I'm screening properly, and I'm getting the right merchandise, right? And I'm not going to worry if, I bought this great stock and I'm up 20%. I woulda, shoulda, coulda. I should have bought 20% of my portfolio or 50% in this thing. No, that's not the purpose. When you're in these major transition periods of the market, your purpose is just to dip your toe in and just prove to yourself that, hey, I think my analysis is correct, and it's going to show up in that individual trade, making you money, right? And if it's a real bull market, you'll get a second trade, you'll get a third trade, and a fourth trade. So those are some of the words of wisdom we try to set, part on our portfolio manager team and our younger ones, and hopefully your listeners can benefit from that.
Yeah, I mean, a lot of it is just that psychology, right? All of this, 90% of the game is managing yourself, right? And that's what you're talking about right there, that self-awareness.
And what Steve's talking about is we are always trying to be in sync. So he's talking about now getting back into sync with what is potentially a emerging uptrend, right? So it's a concept we talk about in our shop here, the batting average, and it's a shorter term concept. So let's say you have 10 trades that you are going to put on over the next couple of weeks or so, and the first two are working, And then all of a sudden, the third, fourth, fifth, and sixth aren't working. You have to be sensitive enough and objective enough and patient enough to say, okay, wait a minute, my batting average started pretty good, but now it's turned down. I need to slow down. And that's what Steve's talking about. I need to back away. Either you trim, in this example, the fifth and sixth purchase, and so you're kind of scaling back down. You were scaling in, but now you're coming back a little, and it's all about risk assessment and adjusting to the risk, right? And probably if you're getting some stocks that aren't working for you, or positions that you're initiating that aren't working, you need to back away much more, because the probability is, and right, what we do in the stock market is a lot of probability, right, throughout. So on the flip side, if the first couple work, you go the next few and they're working, you probably are adding to those initial positions, purchases 1 and 2, and that's now for 1, 2, 3, 4, 5, and 6. And you keep wading in as you're getting the feedback from the market that, yes, you're getting traction and it's working. And so we call that the batting average. And a lot of people overlook this very simple tool. It will tell you very early on if you're out of sync or in sync.
Now, one thing that we know during a bear market is the news is going to be terrible, right? And even at the bottom, even when you get that fall through day, the news is going to be awful. Now, one advantage.
Look at the Arusha. Look at the news right now.
Yes,
we've got massive hysteria everywhere.
Exactly.
Right.
And with the media, everything you turn on the TV, which is why we try not to watch TV too much. It is hysteria. There's a lot of emotion out there. Now, one advantage that we have, being at O'Neill, it is a global organization. And Steve, you're running William O'Neill and Company, and we have divisions in China, we have in India. What are you hearing from our employees over there?
I'll just tell you anecdotally, and this is, yes, we do. We've had an operation in India, in the Bangalore area, that does, they actually do a lot of the data collection that goes into MarketSmith. So, and that's an interesting backstory there that, people might not understand this, but there's this notion that all data is kind of the same. It's all commoditized. And I had many, many conversations with Bill about the expense to collect your own fundamental data. Because, you can go on Google Finance and you can go to Yahoo, and it seems to be everywhere.
Right, exactly.
What's really interesting is Bill would always come back and say, that the quality control of that data is really questionable. And one of the primary inputs in some of our ratings and rankings is earnings growth and the EPS rank. And we back out a lot of, our teams will back out non-recurring and extraordinary items. So we're using non-GAAP earnings to really get an idea of what the operating earnings are. And so about 10 years ago, and we've done this here. We did this in Los Angeles since 1963, right? We had a data center and we had a data collection team that was, taking the income statement, balance sheet, and cash flow statements on U.S. companies and building that database since the early 1960s, one of the very, very first computerized stock market databases. But I think in about 2012, 11 and 12, I led an initiative along with Terry Chan, who is one of our executives at one of our operating companies. Terry was our CIO, and we really looked at moving some of that to India. So we have a team over there that is doing content collection. They're doing a great job and they're working as we speak. They're all working remotely. So India just went into their 21-day lockdown. Everybody has connectivity. We connect to our data center. We use AWS, so we have good data redundancy. And it's working beautifully. I get updates every day. We're having no slippage, and the real test for them will be when the earnings start coming out in April, and we'll have to stay on top of the earnings and get those into our warehouse and so it can flow to IBD and MarketSmith and our other institutional products that we sell, and it's a top priority for them. But no, India is not seen because of the there's a lot of, you guys, I'm sure everyone's going to these websites and looking at the heat maps and all the dots, and they're looking at, there's there's a half a dozen sites that are creating these KPI dashboards to get leaderboards, if you will, of where are the cases and how many deaths and so on. India is it's a warm climate. They have had cases of the coronavirus, but it's nothing like what occurred in China or in Europe. And I know they were concerned that they might be accelerating, and they have gone into a shutdown. But we're offices in southern India, very warm, and we're full capacity and we're working. So we've seen no slippage there. And I don't know economically if India is going to be able to maintain a really prolonged shutdown, because so many people there live hand to mouth every day. And to just tell people to shelter in place and not work, it just causes other devastating impacts on the working class. And so they're going to be in a difficult spot trying to weigh the cost benefits of these different policy decisions. In terms of China, what's interesting about China is we have an office in Shanghai, and we actually have some product that we've localized. So we took MarketSmith and we localized that for the Chinese market. It's in there's MarketSmith China. It's in simplified Chinese. It covers Chinese A shares. It's a retail product. So we market that over there. We have another one called MarketSmith India. We market that, and we partner with a lot of brokers in both countries. So the team in China helps us with Chinese data. It's a technology team primarily, and they have been back to work for the last 20 days. I just had an update from our CEO over there this morning.
Okay.
Things are returning to normal. They're not 100% normal, but sorry about the bell. That's the 5 o'clock bell. It's I don't know why that rang, but yeah, in terms of China, things are returning to normal. Everyone is going back to the office. People are still being cautious. They're wearing masks. They're a little concerned about mass transit. So he said the traffic is much worse as people just drive in their cars. But they have reopened up, Beijing, Shanghai,
Wow.
those cities that were on the periphery of where the virus really started in Wuhan. None of our employees caught the virus over there. We had some that were vacationing in Wuhan in Hubei province, where the virus started, and they were just part of the quarantine and the lockdown. So, our takeaway was, and the Chinese have been very, very strict about their, enforcement of their quarantine. There's a lot of discussion over the accuracy of their reported numbers, and there's a lot of doubt over whether their reported numbers are really, they probably underreported. It's not making statistical sense. But they have reopened, and they are returning to normal. And so we saw a report from Nike that there was a pretty quick rebound, that we're surprised at the order rebound flow in China itself for shoes. Some of the semiconductor fabs over there were very concerned about their ability to get the supply chain back up. That's getting restored faster than people expected. They're not at 100%, but the desire to go back to work is certainly there. We're going to have that in the U.S. People want that normalcy, but my CEO tells me that there is still some tension, meaning if somebody sneezes or if someone's sick or sniffling, everyone, you get that sort of shaming glare, like, why are you out?
Right, exactly, yeah.
That's going to probably persist in the United States too. We're right. So much more aware with social distancing and with our desire not to infect anyone else and not to get infected, that I think that'll be around for several months. And that might be one of those things that we look back on and say that was a a real change in psychological behavior that was an outgrowth of this virus. But yeah, and then we have an office in London, and they're in the midst of their lockdown, so that's pretty much shut down, and as is our offices in New York. But the real beauty of this, and one of the stocks that I'm sure our audience has been talking about is Zoom. We were an early adopter of that technology. We've been using them for many years. Have really went through because we're a global firm. We've used video conferencing. We've used $10,000 systems, Scott. I'm sure you remember some of those ones we had with the big cameras years ago to video conference. And we've used Zoom. We're a consumer of the product, that's allowed all of our businesses globally to keep operating at really full capacity. I mean, my work days actually gotten longer working from home. So.
Yeah, it is kind of funny. I've heard that a number of times. It's definitely happened to me too. It's like working from home, you don't really have a break now for lunch or anything like that. Another thing is, I know for IBD, we moved for a lot of handling the phones, the customer success team, we moved to 5.9. And so that enabled us to, everyone works from home, everyone answering phones, making calls. We're all doing it from our homes now. We're broadcasting, we're recording webinars, we're doing the podcast, we're all at home. So it is pretty remarkable how different this experience would have been maybe 5 years ago, 7 years ago, when all of these cloud technologies weren't really ready to be consumed at that point.
Right. Yeah, 5.9 and Zoom are interesting. 5.9 as a stock itself is a very interesting growth name to take a look at. Zoom, I see you have it up on the screen here.
Yep.
This is one too where everybody can see the relative strength line and the relative strength ranking in 99. If you're listening in, it's the stock is up near, it's up near, we're looking at the weekly chart right now, and it's up near I think that's the weekly, right?
Yes, yeah, I just switched to the weekly. Yep.
Yeah, so
and the key on a stock like that is now you've identified a really great one. You've got to find a low risk entry point. I'm sure, Rusha, you've talked about that over and over, because it looks perfect here, except to buy. I think that would be very dangerous, but boy, does it look nice.
This concludes part 1 of this episode. In part 2, Scott and Steve are going to talk about some of the larger growth trends and some of the stocks that could do well in the next uptrend. Stay tuned.